Okay, hello everybody. Welcome to Create and Land to Mentorship. So, for those of you who are new to this channel, I actually paid off my mortgage under 3 years. So if you take a look at this community feed, I paid it off, and so I've been getting emails from Capital One saying, "Hey, check for your pre-approval." And so what's funny is that I actually did decide to check yesterday, and so they have this section about paying the monthly rent. How much do you pay in your monthly rent and mortgage? And I put zero. You know what's funny is that Capital One said, double check this. I don't think this is right. And I'm just like, if you pay zero, you can still continue, but you should double check, right? And I'm like, all right, well, this is right. And I didn't actually apply for a Capital One card, but Capital One is like the only major credit card that I don't have. And then it also says here, enter the amount you individually pay for housing, excluding utilities. If someone else pays for you, enter zero. So here's the other thing, or here's the way I interpret this. Capital One is probably suspicious of you if you don't have a rent or mortgage payment. And so it's like trying to say it in the most nicest way, hey, if you got a sugar daddy or sugar mama, it's okay to put in zero. I feel like that's what Capital One is saying, but don't worry, Capital One, I don't have a sugar mama or daddy, but although, maybe once in a while it's nice to have one, but I don't got one. And so, but I just thought it was so funny, kind of shocking that they actually put a warning system in their application saying, or the pre-approval credit card checker saying, like, is this right? Like, this seems a little bit off. And it's like, dude, the banking system does not expect us to pay off our mortgages quickly. Isn't that crazy? Like, you only program these messages if you think like your user is gonna make a mistake. You know what I'm saying? So that's the crazy part. And so Capital One is just saying, hey, you got a paid off mortgage. You probably a liar. All right. So how did we get here to the paid off mortgage? Well, we're going to review something called velocity banking. So what is velocity banking? So all it is a debt payoff strategy using a line of credit as your main operating account, right? That's all velocity banking is. In order to do velocity banking, there's only two things that we need. Number one is a budget. You write your income, you write your expenses, your leftover savings. This person is doing so well because we're near $1,000 of savings, and we know the average American is nowhere near that. And once you have your expenses, then you have your expense breakdown. And so you got to list every single debt that you have in your expense breakdown, because the whole point of this is that you attack debt, and the more debt you attack, the more cash flow you get attacking other debt, right? And then we're just going to assume we have these non-debt expenses, general food, gas, insurance, that we're always going to have to pay every single month. It's an approximate number, okay? And then so now we did that, and we need a line of credit as a main operating account. A line of credit. What's a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again. So simply stated, it's like you go to a bank's website, click, hey, I want $5,000. You click a button, the $5,000 is in your checking account, and you can use it to pay whatever you want. That's the beauty of a line of credit, like a home equity or personal, right? And here's the thing: for today's demonstration, I'm going to show two things. Number one, I got a personal line of credit, 15 grand, that I'm just have empty and not used, August 5th, 2024. And I have it because I know the secret of banks that you may or may not have heard. Banks don't lend money to people who need it, right? The banks don't. Okay, so you might be thinking, hey, don't I go to a bank when I need money? Kind of like, if don't I go to a restaurant if I'm hungry? Nope. If you go to a bank and they tell you, hey, I need money, they're gonna laugh you out the door. Not probably not a lie, right? And also, let me go ahead and brag about this. I actually got the letter from the bank. Hey, the mortgage was actually paid off. It says we're writing to confirm that the above referenced loan is paid in. Oh, it's out of the screen. Paid in full. Therefore, please be advised of the following. Right. So just another way of I'm going to flex the paid off mortgage. All right, so now let's go ahead and keep continuing. So we're gonna need a line of credit as our main operating account, and so for the purposes of this example, we're just gonna assume we have a 15 grand line of credit and completely empty at a 15% interest rate. And let's go ahead and do the velocity banking side. So we assume two things: number one, same income; number two, zero savings. Right? It's the opposite of the Dave Ramsey method, which is to have savings. And so let's go ahead and do this. Let's go ahead and do this, and then we're going to have something called cash flow, which is just income minus expenses. And in the beginning, this looks exactly like savings. Like, what's the difference between here and here? Well, once we start making our line of credit as our main operating account, this cash flow number is going to automatically increase. So what I mean by that, let's go ahead and move these two credit cards into the line of credit. So you see this 5,000, 6,000. So let's go ahead and move it right here, which is 11,000. And this is month 0. And guess what happens, right? Just by simply moving the debt, we haven't completely eliminated, we just moved it. This goes to 0 and this goes to 0, right? And so now our cash flow goes from $980 to $1,359 in one swoop, right? It just does it in one swoop. $989 to $1,359 in one swoop. And the actual velocity banking strategy is now we're going to dump our entire pay into that line of credit, the entire $4,500. Expenses come out, and then our balance is going to go down about $1,300, right? So there's two main benefits of putting your entire paycheck in the line of credit. Number one is that minimum monthly payment don't matter anymore when you put that entire $4,500. And then number two is that the interest should be reduced because it's based on the average daily balance. So when you put that entire $4,500, then the interest gets reduced because, again, average daily balance, right? So let's go ahead and do the calculations. So we're going to calculate the next month. We're going to calculate the next month's balance, which is based on the previous month's balance. Previous month's interest minus this cash flow number right here, 1359.86, right? So let's go ahead and do that. And then we're going to calculate the interest, again, based on the average daily balance. Take the average of these two numbers, or use the average function Excel. Multiply it by the interest rate, 0.15, right? That's 15%, and then you divide by 12, right? And you can see that the interest is 129 for the month, and you just copy and paste, right? You just copy and paste, and you see, whoop-de-doo, in month 9, that's all paid off. That's all paid off, man, month 9. And so let's go ahead and write that as a milestone, 9 months, and 11K, right? 9 months and 11K. And then now we got these loans right here, student loan, auto loan, mortgage, right? And it's like, which one do I tackle on first? Now, I'm going to tell you my default method of figuring out which one to tackle on first is using something called the cash flow index method, right? So you can see I have this thing called the current cash flow index. So what's the current month? We're at month 9. So if you don't know what this is, basically this calculator tells you what's the balance of the loan if you have the original balance, interest rate, loan terms. So we're at month 9, and you just type in 9 here, 9 there, and 9 there. And then you can see that, hey, we have this thing called, we see the balances of the loans, and we also see something called the cash flow index, right? So all it is think of it as like a ranking system for which debts to pay off. And so here's the thing, right? Like, would you pay off this 20 grand to get $460 back, or almost $200,000 to get double this amount, right? We're going to pay this one first because we're getting half of the mortgage payment by only paying $20,000, right? That's why we tackle this one first. So if we tackle on the mortgage first, we're going to be in a load of paying just to get that $821 back, right? So let's go ahead and at this point, right, we're not dealing with credit cards, higher interest. We're dealing with lower interest rate loans. So a lot of people think it's not valid to use this strategy, but there's a lot of benefits to it. So for example, we're going to prevent something called the segregation of income. And if we can achieve the same effect as overpaying loans, but here's the thing about overpaying loans directly, since loans are one-way streets, right? Like if you overpay a loan, you can never get that money back, unlike a revolving line of credit, because a loan is a one-way street. The lending companies know you're never for the most part, you're never going to overpay your loans, right? It's kind of like having a Netflix account that's only open from 1 a.m. to 6 a.m. and they charge you the lowest amount. Now, if Netflix had such an account, they know that they can charge such a low amount because nobody watches Netflix from 1 a.m. to 6 a.m. At least normal people don't. Maybe some of you do, but I know I don't. In fact, I don't even have Netflix, so good for me. So let's go ahead and figure out what we know that we're going to attack this one, right? That's the one we know, this auto loan right here, auto loan. And so one of the things that we can do when we're dealing with lower interest rates compared to a higher interest rate line of credit is just attack it in pieces. So actually, you might have heard it's called chunking. So let's go ahead and attack it in about $5,000 chunks. So what we do is we just go here, we add $5,000, 5000, okay? And then you can see here that 1, 2, 3, 4, about 4 months it takes us to pay off that $5,000 chunk. Now we're still making that auto payment, but we just rinse and repeat again, and maybe within about 1, 2, 3, 4, I don't know, maybe like 8 months or so. Am I right, or am I totally not doing this? But after a certain point, it gets paid off while doing a chunking method, and you have an easy way of overpaying that line of credit without fearing, you need to have savings. Because again, the opposite of velocity banking is not making extra payments to loans directly. It's actually having a savings account, right? That's really what it is. So if you don't know what I'm talking about, I probably could go over it in another video. But what I'm saying is that we can just simply tackle these loans using a line of credit, even if it's at a higher interest rate. And in fact, the cool thing is that we actually have a velocity banking calculator where we just kind of type in the numbers. So this 24 grand, $20,000 balance, current balance of that loan, and then we put in a 15% line of credit. How much does it come out to? Well, we paid off in 1 year and $854 of interest rather than paying $2,800 of interest. So it's almost like $2,000 of potential interest savings, right? And we put our income expenses, and you might be like, where did I get this cool calculator from? Where it's just like plug and play of using velocity banking. I got it from Renatus, right? Because this is where I originally learned velocity banking from in 2017. And full disclosure, I'm an independent contracting marketer for them, which means I promote and sell their products and get a commission for it. Right? But this is where I learned velocity banking from, so I love using their calculator. It's an awesome calculator. So it tells me I can pay this off in about 1 year. So what we do, again, this is like our cheat sheet. We just kind of switch back and forth and use a calculator. So what I'm going to do is just going to say, hey, 1 year is 12 months, and then this auto loan is paid off. This is 0. So what's 12 plus 9? That's, I think, 21 months. And then 24 plus 11 is 35K, right? 35K. And then now we tackle on the student loan, right? So tackle on the student loan. Why? Because if we go to this loan calculator thingamajigger right here, and this is all paid off, so I don't have to worry about that anymore. You can see that the cash flow index of the student loan, this what is it? We're at 21, is lower than this one right here, right? So if we pay this 30 grand, then we're gonna get $354 of cash flow back, versus if we pay this 192 grand, we're gonna get $821 of cash flow back. So let's go ahead and pay off the student loan. Again, same deal. We do this chunking method, $5,000 chunks. And we're just going to keep doing that over and over again. So I just got to fill in the deets, or the details of the loan, into the velocity banking calculator. So let's go ahead and do that. And I'm just going to look at my screen, go back and forth. So again, I have 2 screens, but you're just going to look at the calculator, and let's go ahead and fill it in. So the original balance of, the original balance of that loan was, I think, 35,000, right? And let me just quickly check. 35,000, 4%, 10 years. So 4%, 10 years, right? And what's the payment, or what's the current balance? It is 354.36. No, that's not right. 3554.36. I'm actually very sleepy, so that's why I'm not like fully operational. No, I'm not. Okay, so what's the current balance? It is 29838.53. 29838.53. All right, got it. And then now, right now, we got to figure out. All right, what is there? I don't think these living expenses are right. So let me just redo this one more time. Or at least let me calculate it on my end, right? So give me 1 second, and so what's the expenses? It's our mortgage plus our other, so that will be 2321.79. So let me do 2321.79. And then as you can see, this pays off in 1.2 years. Whoop-de-doo, right? 1.2 years. Wee-hee. All right, so let's go ahead and go back to the other one. So, hold on. 1.2 years. 1.2 years. Where do we go? I'm so confused. Okay, so this one is 21 plus 1.2 times 12. So it's 35.4, oh, sorry, 35.4 months. And then 35K plus 35K is 70K. Wow, I think it's a coincidence that these first months were 35,000, or at least the first three loans add up to 35, and the second one add up to 35. Okay, no worries. All right. So now let's go ahead and tackle on the mortgage, and we do the same thing, right? We just fill in the numbers. So let me just see what the current balance of this is at 35.4. We'll just assume 36, right? 30. Well, this one I don't have to worry about anymore, but 36. Okay, and then we see that it's mostly paid off at 30. Not mostly, its original balance is 200,000. Look how much got paid off, right? Oh, I'm so delirious. Okay, so now we plug it into our Velocity Banking calculator. So let's go ahead and switch screens right here, and then I'm just going to fill it in. And here's the most important thing that we should learn about the 30-year amortized mortgage. We probably in most instances don't want to replace it with a line of credit. So, for example, you may hear on the internet like, "Oh, you got a $200,000 mortgage at 2.8%. Well, why not replace it with a 9% HELOC?" I'm like, "What?" And I'll tell you what I mean by that. So let's go ahead and do this, right? So the original balance of it was $200,000. And what's the current balance of that mortgage? It is 186,679.5. So 186,679.5. All right, so we got that covered. And then what is our interest rate? It is 2.8%. We got that one of those really cheap mortgages, didn't we? And then let's go ahead and figure out the payment. 821.79, 821.79. Again, so now we just gotta recalculate everything. Let me just redo the expenses because that's the main part, because we assume that our income stays the same. And right now, so let's go ahead. Our only expenses is actually our general expenses like food, gas, insurance, and that was $1,500. Okay. So as you can see here, it takes us about 5.7 years to pay off that loan, right? But what if we followed the internet's advice and said, hey, replace your mortgage with a line of credit? So let's go ahead and do that. Maybe we got a huge line of credit available, 186,679.5, and replace it with the 15% line of credit. Bam! You could see that we actually lose $100,000. Right? So I don't know about you. Do you want to lose $100,000 and actually pay the bank earlier? Because if I were the bank and I saw that this was your plan, I'll be like, shoot, yeah, go ahead and do it. Just as long as you get the line of credit from me, replace your mortgage with the line of credit, and I'll be like so happy because you're paying me so much more, $100,000 more than I thought. So that's what this means is parentheses that you actually did not save interest, right, at all. But if we just do the $10,000, I'm not the 10,000, the chunking method, which is just small pieces, $5,000, right? You can kind of see, whoa, we actually save money now. So that's the most important thing about using a line of credit, especially if we got higher interest rate loans, folks. It is not just purely, oh, higher interest rate line of credit makes more sense than lower interest rate loan. We got to be a little bit strategic and just make sure we do the numbers and understand principles, right? So let's go back to the next, what's it called, Excel spreadsheet. And so we got to record a final milestone, which is 5.7 years. So let me just do this right here. So 35.4 plus 5.7 times 12. And now, was it divided by 12 or times 12? Oh, let's say times 12. Okay, so 103.8. So let's do 103.8 divided by 12, right? And that would be 8.65 years. So 8.65 years, and then we are 200K, not 200K, we are 270K debt free, right? And we did it. We did it. We showed Capital One, you're a liar. I'm not the liar. You're a liar. Because, yeah, got the mortgage paid off under 3 years, and I got the letter from the bank. Hey, it's paid off. We know it. We know it. I remember when I called the bank customer service hotline. I was like, "This is my final payment," and they're like, "I am so impressed." Actually, they didn't say that. They just said okay, and then I think maybe a little congratulations. All right, well, that's it for today. So this is Crane Atlanta Mentorship again. Just another video about velocity banking. And sometimes when you pay off your mortgage, like having a completely pay off mortgage, Capital One or companies like Capital One lenders might think you're a liar, right? Because it's so uncommon in this country to actually pay off a 30-year mortgage in 30 years or under 30 years, right? Because it's just not done, right? And what's really weird is even though it takes the average person more than 30 something years to pay off a 30-year mortgage, there's a lot of free and clear properties out there too, right? So just so that we are aware. Okay, well, that's it for today. So, just a shocking insight with Velocity Banking about how you pay off your mortgage. You know, some of the lenders might think you're a liar because they got all the statistics to know that most people, that's just not done. That's why they got to give you the warning. It's like, well, this ain't common behavior. All right, well, that's it for today, everybody. Happy Sunday, Monday. It's actually 12 something a.m. right now. So, gotta go sleep. Good night, and we'll speak next time.